I want to focus this session actually on the VIX. I think the VIX is sometimes misunderstood. It's known as the fear factor, but why is it called the fear factor? What's really in its calculations that somehow makes it so that it can actually measure what could potentially happen in the market? And is it really measuring anything at all, I guess? To have it that name. So what I want to do with this session is really focus on it, really get into the methodology of how it's actually calculated without really getting into the details of the calculations and really give it a good definition, basically a good overall view of what exactly it's doing, so that everybody has a clear understanding of it. So let's start off. Let's get into the details. So the VIX is actually measuring the expected annualized volatility of the S&P 500. It's specifically, again, when you look at the VIX, it's specifically looking at the S&P 500. Now, there are some other measurements out there that do look at other indexes and are very comparable to the VIX for the S&P 500, but the VIX for the S&P 500 is by far the most is the one that's most seen and reviewed and looked at by investors. But again, the key is that it's really looking at the expected volatility, and we're getting that volatility by measuring the S&P 500 options, both the call options as well as the put options around the value of the S&P 500. And these options are actually out of the money, meaning that they're slightly higher than the value of the S&P 500 and slightly lower, for the put options. And the way we do the calculations is that especially for the VIX, is that there's a greater weight put on the values that we calculate from the put options versus the call options. So in general, it is looking at the overall volatility of the S&P 500, but that is why when the market's really doing well, the VIX is not really increasing. It's really, for the most part, usually decreasing. It can hold its position, for a while and not really move up or down, but sometimes it starts going down, especially as the market's moving up. And usually when that's happening, people are buying call options. They're very bullish on the market, and so they're not really buying put options. And so the values of the put options are going down, and the value of the call options are going up. But they're not going up at a very extreme rate. And so the VIX, uh, you know, either holds its position, especially between, let's say, 12 and 20, or starts dropping within that range to maybe the lower levels. Um, Whereas when we expect the market to go down, then there's a great emphasis on buying put options, and the prices of the put options increase very rapidly, at a very high rate, actually, and that drives, the overall volatility up. And that's when you see the VIX actually going up by quite a bit and actually very rapidly, especially above 20 and even into the 30s, 40s, and 50s. Again, it doesn't happen very often, but when we expect, a very bad downturn in the market, and we start buying lots of puts to protect our positions, that's when we see the VIX really, really moving up. And again, it's all driven by what we expect. If we expect bad things, if we expect negative events, to happen in the market, and then we want to protect our positions. And so we start buying these put options. We don't really focus as much on the call options. The call options are going down, they're decreasing in price. So they're changing rapidly also, but towards the downside, whereas the put prices are increasing quite rapidly towards the upside. And then we see a huge rise in the VIX, in which, in most cases will lead to a very, very likely event where the market drops, or we see extreme reactions up and down in the market. And that's really happening because, again, of what the positions people are taking, both on the put options as well as the call options. Whereas if it's going up, obviously, yes, there's increases in the call options, the pricing of the call options, but the put options are going down, and they kind of like neutralize each other, and so the volatility actually stays muted. But again, the opposite happens basically when we expect again a downturn, then the rise in the put options versus the decrease in the call options is not evenly matched. And so you have these put options going up quite rapidly to very high prices, whereas the changes on the call options are not happening as rapidly and as great as the put option increases or changes. And so you get this increase in volatility. And that's really what it's measuring. So again, if there isn't any angst in the market, obviously we're not really focusing on the put options, we're focusing on the calls. And again, the volatility is pretty much muted. And so you see it by having a value in the VIX of between 12 and 20. Whereas when we expect bad things to happen and we start taking hedging positions, which is really what we're doing with the put options, then we start seeing especially through the calculations. And again, given that there's already a greater bias towards greater volatility based on the put options, especially in the calculations of the VIX, then we see the VIX moving up as if we are, again, taking heavy positions on the puts, expecting bad things to happen, especially in the market, and the VIX rises. So hopefully that clarifies a lot. I didn't go into the actual details of the calculations, but what I've just mentioned, especially taking and the options that we're looking at are basically within 30 days. Um, of where we are. So if the day is the first of the month, then we're looking at options on average that are slightly below 30 days and slightly above 30 days because there is no exact option that actually fits that 30-day billing. And so we're looking at a group of them that are slightly below and slightly above, and then we take an average. And that's how we get to the 30-day volatility. And then we annualize that and we get the actual VIX number. So it's a measure of the volatility. So if it's at 20, it means that there is a 20% per 20% volatility either up or down. If it's at 50, then it's 50% volatility up or down. So that's when we see that those numbers get to those levels of 30, 40, then we expect very, very quick changes or rapid changes and hard changes, actually, very strong changes in the market, especially towards the downside. All right. Thank you. And we'll talk soon.